While millions of investors spend thousands of hours chasing hot stocks, timing the market, and trying to beat the system, you're about to learn a strategy so simple it almost feels like a cheat code. We're going to build a portfolio using just 3 exchange-traded funds, or ETFs, that has consistently beaten the vast majority of investors, including the pros. This isn't about getting lucky. It's about harnessing the mathematical certainty of diversification, low costs, and disciplined rebalancing. If you're ready to stop the frantic trading and start building real, lasting wealth with minutes of effort per year, this is your blueprint. Let's meet the 3 all-stars of this powerhouse portfolio. Each one is chosen for a specific, non-overlapping role that together creates a resilient, high-performing engine for your money. They are Vanguard Total Stock Market ETF, VTI, Vanguard Total International Stock ETF, VXUS, and Vanguard Total Bond Market ETF, BND. This trio provides instant, global, and dirt-cheap diversification across nearly every publicly traded stock and bond on the planet. First, VTI is our core, our foundation, and our engine for growth. When you buy VTI, you're not buying a slice of the market. You're buying the entire U.S. market in a single share. It holds over 3,500 companies, from tech giants like Apple and Microsoft to every small, innovative company you've never heard of. It's weighted by market capitalization, so your money is allocated proportionally to the size of each company, which is a passive, rules-based way to ensure you always own the winners of the future. Its expense ratio is a microscopic 0.03%. This means for every $10,000 you have invested, you pay just $3 per year in fees. This is critical because fees are a silent killer of wealth, and by keeping them near zero, every single dollar of return stays in your pocket, compounding over decades. Second, we have VXUS, our passport to global opportunity. The United States represents only about 60% of the global stock market. By investing solely in VTI, you are ignoring 40% of the world's economic potential and putting all your eggs in one geographical basket. VXUS fixes that. It holds over 8,500 companies across more than 40 developed and emerging markets. Think Nestlé in Switzerland, Toyota in Japan, Samsung in South Korea, and TSMC in Taiwan. Different economies grow at different times and under different conditions. When the U.S. market might be stagnant or declining, international markets could be thriving, and vice versa. This diversification smooths out your ride and provides access to growth you would otherwise miss. VXUS carries a slightly higher, but still incredibly low expense ratio of 0.07%. Third, we bring in our anchor, BND, the Vanguard Total Bond Market ETF. While VTI and VXUS are for growth, BND is for stability and income. It holds over 10,000 U.S. bonds, including government treasuries, high-quality corporate bonds, and mortgage-backed securities. Bonds behave very differently from stocks. When stock markets crash due to economic fear, investors often flee to the safety of bonds, which can cause their prices to rise. This provides a crucial ballast for your portfolio. It reduces the gut-wrenching volatility that causes people to panic and sell at the worst possible time. Furthermore, BND pays a steady stream of interest income, which can be reinvested or used as a cash flow buffer. Its expense ratio is 0.03%. Now, the magic isn't just in picking these 3 funds, it's in how we combine them. The single most important decision you'll make is your asset allocation. What percentage goes into stocks, VTI and VXUS, and what percentage goes into bonds, BND. This ratio determines your portfolio's risk and return profile more than any other factor. For a long-term investor with a horizon of 10+ years and a tolerance for moderate volatility, a classic and proven allocation is 60% stock/40% bonds. But we can refine this further for the modern global investor. I propose the following specific allocation for our 3 ETF portfolio, which I call the Global Balanced Anchor allocation. 45% to VTI, U.S. Total Stock Market, 15% to VXUS, International Total Stock Market, 40% to BND, U.S. Total Bond Market. Why these numbers? This gives you a total stock allocation of 60%, 45% US plus 15% international, but it tilts meaningfully towards the US market. Historically, the US market has been a strong performer with deep, liquid markets and a favorable regulatory environment. The 15% to international ensures meaningful exposure without overcomplicating things or taking on excessive currency or political risk. The 40% bond allocation is the anchor. It is substantial enough to genuinely cushion a stock market crash, providing stability and peace of mind, while still allowing for strong growth from the 60% stock portion. So, how does this simple three-fund portfolio actually perform? Let's talk about backtesting, looking at historical performance, while remembering the vital disclaimer that past performance does not guarantee future results. However, history is our best laboratory for understanding how different asset classes interact. Over the last 20-year period, through 2023, a portfolio with this 45-15-40 allocation would have delivered an average annual return of approximately 6.5% to 7.5%, depending on the specific time frame and rebalancing method. More importantly, let's compare it to the behavior of the average investor. Financial research firm Dalbar Incorporated conducts a famous annual study called the Quantitative Analysis of Investor Behavior. It consistently shows that the average equity investor underperforms a simple buy and hold index strategy by a staggering margin, often by 3 to 4% per year over decades. Why? Emotional decision-making. Buying after prices have soared out of greed and selling after crashes out of fear. Our 3 ETF portfolio automates away these emotions. The back-tested data shows that this portfolio would have handily outperformed the Dalbar average investor return over nearly every rolling 10-year period. It likely wouldn't have beaten a 100% S&P 500 portfolio in the strongest bull markets, like the 2000s. But it would have captured a large portion of those gains while suffering dramatically less damage during the brutal bear markets of 2000 to 2002, 2008, and early 2022. This is the key. Consistent, good enough returns with less gut-wrenching risk often lead to higher real-world investor outcomes than chasing volatile, high returns. Psychology is everything. A portfolio that drops 30% might cause an investor to abandon ship. A portfolio that only drops 15% in the same crisis is something an investor can hold on to, allowing them to stay invested and recover fully. By surviving the downturns, you capture the eventual recoveries. This is how a boring 60-40 portfolio beats 90% of investors, not by being the flashiest rocket ship, but by being the most reliable and psychologically manageable vehicle for the long journey. Let's analyze the risk in concrete terms. The worst calendar year for a 100% S&P 500 portfolio in recent history was 2008, with a loss of about 37%. For our 45-15-40 portfolio, the worst year would have been significantly less painful, with a loss in the range of 20 to 25%. That is still difficult, but it is a survivable decline. The standard deviation, a measure of volatility, of this portfolio is roughly 1/3 lower than a 100% stock portfolio. The Sharpe ratio, which measures risk-adjusted return, how much return you get per unit of risk, is significantly higher for this balanced portfolio than for an all-stock portfolio. Now, the final piece of the system that makes this all work mechanically: rebalancing. This is the disciplined process of bringing your portfolio back to its target allocation. Over time, as your investments perform differently, your percentages will drift. For example, in a great year for stocks, your 45% VTI allocation might grow to 50%, while your 40% BND allocation might shrink to 35%. You now own more risky assets than you intended. Rebalancing forces you to do the emotionally counterintuitive but financially brilliant thing: sell high and buy low. You would sell some of the outperforming VTI, selling high, and use the proceeds to buy more of the underperforming BND, buying low. This systematically removes emotion and enforces a rhythm of profit-taking and bargain shopping. There are 2 simple rebalancing rules. 1, calendar-based. Pick one day a year, for example, your birthday, January 1st. On that day, check your allocations. If they are off by more than a few percentage points, sell and buy to get back to 45/15/40. 2. Threshold based. Whenever any single holding deviates by more than 5% from its target, for example, VTI moves above 50% or below 40%, you rebalance. For most investors, the annual calendar method is perfectly sufficient and simplest to remember. This entire process, from checking your statements to placing two trades, should take you less than 30 minutes per year. That's it. 30 minutes a year to manage a portfolio that outperforms the vast majority of people glued to their screens. Let's project what this looks like in real dollar terms. Assume a starting investment of $10,000 with annual contributions of $6,000, like maxing out an IRA, an average annual return of 7%, and annual rebalancing. After 10 years, your portfolio would be worth approximately $100,000. After 20 years, your portfolio would grow to about $280,000. After 30 years, you would be looking at a nest egg of over $650,000. And remember, this is from a strategy requiring almost no maintenance. The power comes from the contributions, the compounding, and the rebalancing, not from genius stock picks. The beauty of this 3 ETF portfolio is its universal adaptability. The 45-15-40 split is a perfect middle ground, balanced allocation, but you can adjust the dials based on your age and risk tolerance. Aggressive, young investor, 30-year time horizon. 63% VTI/27% VXUS/10% BND. 90% stocks/10% bonds. Conservative, retiree, focused on income/preservation, 25% VTI/10% VXUS/65% BND, 35% stocks/65% bonds. The relentless pursuit of market-beating returns is the grand illusion of modern investing. It's a siren song that lures individuals into a labyrinth of complex strategies, expensive products, and emotional decisions that statistically almost always lead to failure. Study after study confirms a brutal truth. The vast majority of professional fund managers fail to outperform their benchmark index over a 10-year period. For the individual investor, the results are even more dismal, with behavioral pitfalls, panic selling, greed buying, and overtrading eroding returns by several percentage points annually. In this context, victory is not defined by spectacular wins, but by avoiding catastrophic, self-inflicted losses. The real secret to joining the top tier of investors isn't about finding the next Tesla. It's about constructing a fortress of a portfolio that is psychologically manageable, economically efficient, and mechanically sound. This is the profound power of simplicity. By embracing a strategy that seems almost too basic, you systematically eliminate every major error that plagues the average investor. You are not playing their game. You are building a wealth machine on a foundation of academic evidence and behavioral discipline. And it starts with letting go of the need to be clever and embracing the power of being consistently, boringly right. To understand why a 3 ETF strategy is so potent, we must first diagnose why most portfolios fail. The first killer is cost. Every dollar paid in expense ratios, advisor fees, transaction commissions, and bid-ask spreads is a dollar that cannot compound for you over time. A 2% annual fee might sound trivial, but over 30 years, it can consume over 40% of your potential portfolio value. The second killer is concentration risk. Betting heavily on a single stock, a single sector, or a single country is not investing. It is speculation. For every investor who struck gold with a single tech stock, there are thousands who saw their wealth evaporate with companies like Enron, Lehman Brothers, or GE. The third and perhaps most insidious killer is behavioral bias. We are hardwired to follow the herd, to extrapolate recent trends indefinitely, and to feel the pain of loss twice as powerfully as the joy of gain. This leads to buying at market peaks when optimism is rampant and selling at market troughs when fear is paralyzing, a recipe for permanent capital destruction. The 3 ETF portfolio is the antidote to all 3 poisons. It is engineered for cost efficiency, holding funds with expense ratios so low they are virtually negligible. It is engineered for diversification, owning such a broad swath of the global market that the failure of any single company, industry, or even country cannot derail your long-term plan. Most importantly, it is engineered for behavioral success. Its simplicity makes it easy to understand and trust. Its periodic rebalancing mechanism creates a systematic, rules-based process that forces you to act against your emotions, selling a bit of what is done well to buy more of what has lagged. This transforms investing from an emotional roller coaster into a dull administrative task, which is exactly what it should be. The goal is not excitement, the goal is financial freedom, and freedom is best built through quiet, consistent, and unremarkable steps. This philosophy is championed by some of the greatest financial minds in history. Jack Bogle, founder of Vanguard, built an empire on the premise that simplicity is the master key to financial success. Nobel laureate Harry Markowitz's modern portfolio theory demonstrates that diversification is the only true free lunch in finance. You can reduce risk without necessarily reducing expected returns. Our 3 ETF portfolio is the direct, practical application of these foundational ideas. It represents the culmination of decades of financial science distilled into a strategy so straightforward that anyone can implement it. It requires no forecasting, no stock analysis, and no timing of the market. It requires only the discipline to set it up, fund it consistently, and rebalance it periodically. In a world flooded with conflicting advice and complex products, this elegant simplicity is not a weakness. It is its ultimate strength. Before we even name the 3 funds, it's critical to set the right expectation. This portfolio will never be the top performer in any given year. During a raging bull market focused on U.S. tech stocks, portfolios heavy on NASDAQ index funds will leave it in the dust. That is not its purpose. Its purpose is to be a long-term wealth compounder that delivers very good returns with significantly less volatility and heartache. It is designed for the marathon, not the sprint. By smoothing out the ride, it dramatically increases the likelihood that you, the investor, will actually stay invested through the inevitable storms. The history of markets is written by those who remained seated. This portfolio is your comfortable, durable seat for a lifetime journey. It removes you from the day-to-day drama of financial news and aligns your capital with the long-term upward trend of global economic progress. You are not betting on a story. You are owning a stake in human ingenuity and productivity itself, packaged in its most efficient and reliable form. The framework remains identical. You simply change the percentages in the same 3 funds. As you age, you might gradually shift from the aggressive mix toward the balanced and finally to the conservative mix, a strategy known as a glide path. In a world of infinite financial complexity, overwhelming choice, and constant noise, the greatest advantage you can give yourself is simplicity. The 3 ETF portfolio of VTI, VXUS, and BND provides that. It gives you global diversification, near zero costs, automatic rebalancing bonuses, and a structure that keeps your emotions in check. It won't make for exciting cocktail party talk, but it will make you wealthier than almost everyone else at the party. Stop trying to beat the market. Start owning all of it, simply, cheaply, and forever. This is the portfolio that does the work for you so you can get back to living your life.